If you're a C corporation, you're normally going to have an asset sale. If you're an S corp, you can either have a stock sale or an asset sale. It really doesn't matter because it's a pass-through entity. You do have to be careful, though. There's a 5-year requirement. If you've converted more than 5 years ago from a C corp to an S corp, there's no recapture of taxes. If you have converted 2 years ago to be an S corp, sell your company, everything is going to be taxed as if you were still a C corporation. So you really should talk with your CPA, your attorney now, to see if you want to convert to an S corp, see if it makes sense for you. Partnerships and LLCs, they're taxed the same as an S corporation, so the type of deal really doesn't matter. An installment sale is a great opportunity for a seller. You can take some of the income, spread it out over a number of years, and anticipation that your tax bracket will be lower in a couple years from now than what it is this year, next year. And as Mike mentioned, you could also do a tax-free stock exchange, which would defer your taxes also. Some of the tax basics, you're going to have corporate taxes if you're a C corp, and you're going to have shareholder taxes. New tax laws could affect the outcome of the sale of your business. We don't know what taxes are going to be next year. Currently, for C corporations, your maximum rate is 35%. Under President-elect Donald Trump, he's proposing a 15% maximum rate. Let's hope that happens. That'd be great for everyone. Pass-through entities, as I mentioned, only pay at the shareholder level. You do have the double tax potential in a C corp. There's no distinction of capital gains in a C corp. Everything is taxed at the maximum rate. You also have to be aware of recapture of depreciation, which means that if you've been taking accelerated depreciation, the difference between that and straight line could be added back as ordinary income. If you've written off assets under Section 179 and the life of that asset's not expired, that's going to be added back as income also. For individuals, there's an additional investment tax of 3.8%. So your capital gain that's passed through to you individually will be taxed at the additional 3.8% under current tax laws. You have two types of sales. You have an asset sale and a stock sale, and they're really the two forms of any business deal. An asset sale is more common in the lower middle class markets. Actually, I'm not going in the same order as the slides, so sorry. A buyer generally prefers to have an asset sale for its tax savings and liability exposure is minimized. Buyer will pursue a stock purchase when necessary to better secure intellectual property, licenses, contracts. The seller, as I said, generally prefers a stock sale for its simplicity, its tax benefits, and to avoid liability exposures, especially if it's a C corp. Previously, we've been talking about enterprise value, intrinsic value. It is usually higher in an asset sale versus a stock sale. Due to the tax benefits the buyer will have. Buyer will get a step up in assets in the asset deal. Buyer can write off goodwill as an asset in an asset purchase, which will give him additional after-tax cash flow. As Kevin mentioned on valuations, it really doesn't matter on the valuation what type of sale it is. If it's an asset versus a stock sale, the value is still going to be the same. Buyers will generally pay more for an asset sale. Allocation for the amount paid for the business is an important part of the deal structure, especially when it's a lump sum payment. The The lump sum payment is considered a sale of each individual asset that the corporation owns or entity owns. There's a Form 8594 that both parties will have to file with their tax returns, and that's basically taking 5 different categories and breaking the assets out under those different categories because they're taxed differently and depreciated differently. Proposed regulations right now are aiming at closing some loopholes on the valuation side. If a individual is going to transfer for estate or gifting purposes, for valuing intra-family transfers of interest in corporations and partnerships, what's proposed right now is to disallow minority discounts, which could be a big factor in gifting. Asset sale versus stock sale, the net proceeds. From a net proceeds perspective, a stock sale is preferred over an asset sale for a seller. However, in certain situations, an asset sale tax liability can be negligible. An S corporation should be indifferent between an asset sale and a stock sale unless there is significant depreciation recapture. A C corporation can be indifferent between an asset sale and a stock sale if the purchase price is close to the cost or basis of the assets, meaning that your goodwill is minimal. This is usually not the case, though. The tax liability is significant for a C corp in an asset sale for a low asset business, basically a service business. In this past September, one of my manufacturing clients sold for about $2.5 million. We've been planning the sale for quite a few years, and we structured the deal where I was able to take $750,000 of that sale amount, transfer it out of the corporation to another entity, making that $750,000 all capital gain, taxed at a capital gain rate. This saved the client about $250,000 in taxes. So long-term planning, proper planning is really important. Don't wait till 6 months before you're going to sell your company just to think you're going to save a lot of money in taxes. It takes a lot of planning. Your key elements of the net proceeds are your enterprise value minus your interest-bearing debt, plus or minus post-closing adjustments, balance sheet targets, working capital true-ups, unrecorded and off-balance sheet liabilities, escrows, and holdbacks. I had an attorney call me this past January to provide some litigation support for a case he was working on. It's a local company here in St. Louis. They sold a division of their company. The issues dealing with the lawsuit were that the other side was claiming the inventory was understated, that the working capital true-up was incorrect, and the balance sheet targets were incorrect. I spent about 6 weeks on this project, so I was happy to do it. I was paid well. I went to court at the end of March in Delaware for this case. This case today is still open. It's still pending. The client has spent at least $500,000 in legal fees, all to try to obtain his $2 million in his escrow account. So deal structuring is very important. There was 2 other issues with this client. One is he had a bad contract. There was parts of it that were controversial. One paragraph contradicted another paragraph, and it took me 8 hours to read the sales contract. I mean, it was 6-7 inches thick, and it was prepared by a well-known firm here in town. The other issues on the inventory side were there's too many handshake deals. We can do this, we can move this here, we can do all the different types of things. Do not ever sell your company and have handshake deals. Everything should be in writing, unless you want to go to court, because that's what will happen. As far as the net proceeds, there are earnouts also, and those are usually paid out over a 3 to 5 year period. You're usually lucky if you can get any of the earnouts. And then the other thing to be subtracted from your net proceeds are minus the fees and expenses, which can be very expensive. With this, my company that was sold in September, I probably had a month's time in it, just going through the records, looking at the deal, just preparation for the sale of it. Last item from net proceeds are your taxes. That's a tough issue right now to call. With the new president coming in, with all the changes that he's proposing, we just don't know where they're going to end up next year, the year after that. I mean, my opinion, if taxes are down, it may be worth looking at possibly selling your business or even a portion of it to raise some capital with the lower tax rates, assuming we get those. A buyer is going to be focused on enterprise value and ability to earn a return on his investment. Buyers usually like to have a multiple of 5 times EBITDA, which Kevin explained what EBITDA was, and that's about a 20% return for the investor. That's kind of the minimum amount that investors want to see when they're looking to purchase a business. Seller may be focused on the enterprise value, but they should really be focused on the net proceeds, because that's what their lifestyles are going to be based on. And Mike explained the lifestyle situations and how to prepare for that. Let's see. I'm going to go through a stock sale and an asset sale, what the advantages, disadvantages are to a buyer and a seller. In a stock sale, advantages for a seller, you have capital gain treatment. It's simple and easy. The liability exposure is avoided, but it will usually involve a holdback. Buy-sell agreements, when carefully crafted and applied in certain circumstances, can minimize tax consequences of gifting or transfers. Disadvantages to the seller in a stock sale is it's more difficult to retain certain assets in the business. Company vehicles would be an example. And then there's also a need for additional warranties. Your holdbacks usually will be a little bit higher in this type of sale. And it may be a longer term for the holdback also. Advantages to the buyer when they have a stock sale is that the contracts, IP, and other rights all remain intact. Accounting methods, tax attributes remain the same. Disadvantages to the buyer are liability concerns, lawsuits, warranties, taxes, and other issues. There's no step up in basis for the buyer unless they file for a code section 338, which basically allows them to take a stock sale and change it to an asset sale as far as tax purposes. There's unwanted assets or contracts that are part of the transaction, possible loss of the NOL carryovers if they have any, or any other favorable tax attributes. It may terminate your S election. On an asset sale, advantages to the seller are you only sell assets desired, so the owner gets to keep his company vehicle, boat, plane, condo, whatever he may have that he's running through the business. You retain the corporate structure. You can utilize tax attributes. You reduce your reps and warranties. The disadvantages to seller is cost of liquidating your entity, retain contingent liabilities, potential double taxation if you are a C Corp, and then your depreciation recapture. The advantages to the buyer under an asset sale is you avoid contingent liabilities. You get the step up in basis for depreciation and amortization purposes, ability to choose own structure and accounting methods, refuse unwanted assets, liabilities, or contracts. And you get to it's basically a pick and choose method. The disadvantages to the buyer are difficulty of transferring assets such as contracts, IP rights, and loss of favorable tax or business attributes.